Is this a Federal Reserve that has the luxury of waiting?
I think they have to wait because they're not really sure what's going to happen to the economy, both on the inflation side and the labor market side. And I think they have a reason to wait because, as Powell said, the unemployment rate hasn't changed. So essentially, what's happened over the last 6 months is labor demand has slowed, but labor supply has also slowed because of immigration policy. And he was very explicit about that. He really said to focus on the unemployment rate. It's basically in the same place as was last summer. So I think, the message from this, press conference was very clear. We're not in a rush. He also mentioned multiple times that it's going to take time to figure out what the effects of the tariffs are going to be. And he also made it very clear that what he's focused on is making sure that any rise in inflation doesn't become persistent. He really wants to keep inflation expectations in check. And one of the ways you do that is by being patient.
Bill, how did you understand you don't see a weakening in the labor market, but you do have downside risks, and those downside risks are growing? Can you put that together and translate it?
Well, the way I would think about it is the payroll employment growth rate has slowed. Okay, and so if it keeps slowing, that eventually is going to be a problem. But what hasn't happened is the labor market hasn't actually loosened up because the unemployment rate is exactly where it was. So it's two things that have been happening together. Labor supply growth is coming down. Labor demand growth is coming down. I think they're worried about the downside risk because they do see this decline in labor demand. But it's not a problem right now because the unemployment rate hasn't moved at all.
Bill Dudley, Bob Michael was on with J.P. Morgan, and he floored me with an 18%, even 20% modeled tariff rate. The people that aren't that sophisticated, they're listening, they're watching, and they're going back to the 1930s with those kind of rates. Are we leading to an economy that has the kind of tensions we knew in the 1930s, where the have-nots struggle even more with an all-in 19% tariff rate?
Well, there's a big difference. 1930s, you have a depression, and then you have the tariff wars, right? This is the tariff wars, and the economy is actually doing okay. So I think you have to think of the depression as quite different because the Smoot-Hawley was a reaction to what was happening in the economy. I think it's actually a little bit worse in terms of the magnitude of the tariff shock compared to the 1930s because the share of imports of GDP was much lower than it is now. So this is actually a more sizable shock.
I'm fascinated, Bill, with your study of history, how our central bank should adapt to a blended 19% tariff. Is there any template for where we're heading in 26 and 27?
You're explaining exactly why the Fed's being quite patient. We don't have a template for this kind of shock. We don't know how quickly it's going to pass through into inflation. We don't know how that's going to affect inflation expectations. We don't know how the uncertainty about the trade policy is going to affect a business fixed investment. So we're in sort of uncharted territories. And when you're in uncharted territories, you want to be very cautious. And I think that's what the Fed is being at this point.
Governor Waller is making a different point, Bill, as you know. In a recent speech, he said a large share of tariff increases won't be passed through to consumers. He went on to say the increase would fade over the next year or so. What is it about his argument that you don't find that convincing?
I think he's putting too much weight on what's happened so far as opposed to what will ultimately happen. Most economists believe that most tariffs get passed through to the consumer in the end. That may not happen instantaneously, but that's what has happened historically. So I'm expecting a pass through. And every 1% increase in tariffs as a percent of imports is worth about 0.1% on the price level. So if we're going from 2.5% tariffs of imports to 17, 18%, that's about 1.5% on the level of prices.
Right now, the market's expecting that next year you're going to see a pretty big rate cutting cycle, regardless of the economic data, almost just simply because of there being a new Fed chair who has a particular mandate. You can put aside the idea of whether or not you think that that's good or bad. Do you think that that will lead to higher inflation, given the fact that right now, even if the Fed remains on hold, we're talking about 50 basis points and then pushing it into next year?
I think we should be careful not to overstate the fact that the chairman is going to change, because there's 12 people on the Federal Open Market Committee, and those people aren't going to do what they think is inappropriate. So the chairman has to sort of bring along the rest of the committee. The second thing I would say is, the disagreement in the committee isn't quite as large as people are making it to be. Pretty much everybody expects rates are going to fall over the next couple of years. It's just a question of timing and magnitude.
You've been in the committee, you've been in the room for some of these Fed meetings. We heard that this was one of the better meetings. That was what Fed Chair Jay Powell said, and that he thought that it was a really robust discussion. Can you translate what that means?
I think what he's saying is that we're all still friends and we're all still getting on and we respect each other's points of view. So he started downplaying the importance of what the dissents mean. And I think that's right. I don't think the dissents are a big schism in terms of the monetary policy outlook. The fact is, if you look at the summary of economic projections, every single respondent expects interest rates to be lower at the end of next year.
We've gotten through the last hour and a half here, Bill. I have to say, we haven't mentioned the dots. That's a good and beautiful thing. What do the dots do forward, given this exceptional tariff uncertainty? I don't know. John, how do you create a dot?
Got to wait until September, get a new round.
Well,
I know, but
that's one of the problems with the summary of economic projection. It's a modal forecast, but it doesn't really tell you that much about uncertainty around that forecast. And the uncertainty around that forecast is quite large right now.
I want to interrupt the show. John, you mentioned to me Meghnad Desai has died in London, the giant of London School of Economics. Bill Dudley, Meghnad Desai's strength was humility. What's the humility we need right now in two Americas, a boom economy, and a lot of people really struggling? What's the humility our central bank needs?
Well, I think Chairman Powell does have humility. I mean, that's precisely why he's not cutting rates today, is because he's uncertain about what the economic outlook is. So he's not prejudging what's going to happen because he doesn't want to make a mistake. So I think he's showing appropriate humility as the chair of the Federal Reserve at this point.